Welcome, everyone. I'm Kara Griffith, the President and CEO of Tax Analysts. I'm so pleased you've joined us for a discussion on partnership tax. We'll be delving into such issues as whether recent reform proposals in both the Senate and the House would simplify the tax code, and the likelihood that any legislation will be passed this year or in the near future. So with our panelists today, we'll basically be trying to predict the future of partnership taxation. Today's event is the 13th in Tax Analyst series of public discussions that we call Taxing Issues. We launched this series last year as another means of encouraging debate on tax issues. We've been bringing the tax community together with leading policymakers and experts for bipartisan discussions on the future of tax policy. While I hope that we can hold an in-person event sometime next year, we will for now, and probably for some time to come, continue to hold these discussions in a virtual format. And we welcome your feedback on how to make them more interactive. We also welcome your suggestions on future webinar topics. You can send your feedback and suggestions to events@taxanalyst.org. We also welcome your questions for today's event. Thank you to those of you who emailed your questions in advance. Please use the chat feature to submit questions during today's event. For our panel discussion, I will begin by asking a few questions, and then I will turn to questions from you, our audience. And I promise to get to as many of your questions as time permits. And now, onto the topic at hand. Partnerships are a widely used type of business entity. Many businesses across different industries are structured as partnerships. A partnership is, of course, a pass-through entity, meaning the entity itself is not taxed. Rather, income and deductions are passed through to the partners, but the allocations of income and deductions to the partners don't necessarily have to be in proportion to the partner's ownership in the partnership. Under federal tax rules, partnerships have had a great deal of flexibility in how they determine each partner's share of its income and deductions. This flexibility is designed to enable taxpayers to vary their allocations for legitimate business reasons, while disallowing allocations that make partnerships do for mainly tax avoidance purposes. Partnerships have widely used, perhaps overused, this flexibility to minimize the tax liability of their partners. As early as the 1960s, when tax shelters were first making headlines, Congress and the IRS began to regret the flexibility that they gave to partnerships. And they've been trying to put the so-called genie back into the bottle ever since. That is, they wanted to make partnership tax rules less flexible and less subject to abuse. And while policymakers have not enacted sweeping changes to partnership rules, they have imposed numerous anti-abuse rules that have made partnership taxation one of the most complex areas in all of tax. In fact, partnership tax law is so complex that the IRS has effectively given up auditing large, complicated setups with many partners. The Treasury Department has estimated that billions in revenue is lost each year to pass-through entities because the rules that govern partnerships are simply too complex for the IRS to enforce. In 2021, Treasury argued that half of the individual income tax gap was attributable to pass-throughs. The Tax Cuts and Jobs Act of 2017 did little to make partnership tax less complex. In fact, among the most complex provisions of the TCJA was the new 20% deduction for qualified business income earned by a pass-through. So fast forward, in July of 2021, Senate Finance Committee Chairman Ron Wyden released draft legislation to change how the Section 199A deduction works and who can claim it. The proposal would phase out the amount that eligible taxpayers can deduct under Section 199A as a taxpayer's income grows, completely eliminating deduction for individuals making more than $400,000. The bill would also remove many other limitations on Section 199A deductions. A September draft bill from Wyden, which we will discuss in depth today, is even more wide-reaching, and among other things, would affect partnership allocations and shifts of built-in gains. The chairman estimated that partnership reforms could generate $172 billion in revenue over the next 10 years. In the tax plan to help fund President Biden's economic recovery legislation, the House Ways and Means Committee also proposed to cap the amount that eligible taxpayers can deduct under Section 199A, permanently limit excess business losses, and restrict the tax benefits of carried interest, among many other changes. So would either the Wyden or the Ways and Means proposal help simplify the tax code and generate revenue? And in the absence of either, What does the future look like for partnership taxation? Well, thankfully, we have an outstanding panel to address a host of issues. First, we have Andrea McIntosh Whiteway. She's a principal in the National Tax Office of Ernst & Young, based in Washington, D.C. Next, we have Karen Burke, a professor of law and the Richard B. Stevens Eminent Scholar at the University of Florida Levin College of Law. And finally, we have Eric Sloan, a partner in the New York and Washington, D.C. offices of Gibson, Dunn & Crutcher. He's also co-chair of the firm's tax practice. Welcome to all three of you, and thank you for joining us today. I think this is going to be a really interesting discussion, and I know I stand to learn a lot. So, Andrea, I did a very high-level overview at the outset here, but to help stage the discussion today, could you provide us with a more detailed look at what's in the Wyden proposal?
Sure, and thanks for having me, Kara. I'd like to start off by saying that I personally support an effort to reform the Internal Revenue Code in an effort to make it more simple and easy to administer. I was struck reviewing a lot of the proposals that are in Wyden that many of these proposals are things that have been resurrected from the past. In 2013, my former colleague Blake Rubin testified before the subcommittee of the House Ways and Means Committee on the then discussion draft on reform of taxation of small business and pass-through entities. And many of the proposals that he had encouraged for enactment then are still outstanding, including the repeal of the guaranteed payment rules, rules relating to liquidation of retiring partners under 736. And I think those types of provisions being repealed would go towards furthering the goal of simplification. However, as he observed at that time, and I think are equally applicable today with regard to many of the proposals that I'm going to mention here, and I quote from his testimony, some of the proposed changes are not warranted because they will add complexity in many cases where the existing rules serve their intended purposes. His comments then were directed at mandatory basis adjustments, making the anti-mixing bowl rule time period, eliminating the time period, and making changes to Section 751. Some of these changes are, again, as part of what Wyden is proposing now. So we're going to briefly run through the Wyden proposals and then dive in and talk about whether they make sense or not and what might be done to sort of improve upon what's being proposed. First, very briefly, Section 701, entity level taxation. The change here would allow the IRS to enhance reporting requirements for partnerships, basically saying that a partnership can be subject to an entity level tax. Our understanding from the summary is that it's there to align the tax reporting for financial accounting standard purposes regarding uncertain tax positions. Next is 704B. With respect to 704B, the discussion draft would remove the substantial economic effect test for partnership allocations and rather would require allocations be made according to the partner's interest in the partnership. These changes would be effective for tax years beginning after December 31 of 2023. And I know we'll have some robust discussion about that particular change in a few minutes. Coupled with the requirement for PIP is a special rule when you've got members of a controlled group in a partnership using 50% under Section 267E3. And if you have partners who are members of a controlled group, you can't use the PIP standard. Rather, you have to apply a consistent percentage method approach that looks to actual net contributed capital into the partnership. There's a lot of, obviously not a lot of need for additional regulations and guidance if that provision gets enacted. Mandatory revaluations under Section 704B, the discussion draft would make mandatory revaluations, which are now by and large elective, although highly suggested that they be made. They would become mandatory and upon specific changes in the partnership's economic arrangement in the partnership. And it would require that the revaluations also be pushed down through tiers and would extend the 704C1C built-in loss rules to revaluations as well. And these this would be proposed to be effective 12/31/2021. 704C built-in gain rules. Right now we've got the three methods three methods that we can use to correct, if you will, for the disparity between basis and value on contributions into partnerships. The discussion draft proposes that we require all partnerships to use the remedial allocation method, and that would also apply to the revaluations. We just said that revaluations would be mandatory. You'd be mandatorily also required to use remedial allocations with respect to both property contributions and revaluations occurring after December 31, 2021. I mentioned the anti-mixing bowl rules. Once again, this discussion draft would amend 704C1B and 737 to eliminate the 7-year period for applying the mixing bowl rules, in essence, making the anti-mixing bowl rules permanent in application, and it would apply to property contributed after December 31 of 2021. Disguised sales is the next place in the discussion draft that there are changes being proposed. 707A2 right now, as drafted, appears to require regulations be enacted by the Secretary in order for you to have a disguised sale of a partnership interest. The discussion draft says disguised sale of partnership interest provision is self-executing and we don't need to have regulations. The proposal would apply to property transferred after the date of enactment, although many of us already think there's a rule that says you can't have a disguised sale of a partnership interest, notwithstanding their proposed change there. Disguised sale of property, there's a helpful exception in 707 regulations for reimbursement of pre-formation expenditures, and a pretty well thought out regulatory regime there with guardrails about how much you can get reimbursed without being subject to disguised sale rules. That's being proposed to be statutorily shut down, so they'd no longer be able to rely on an exception for reimbursement of pre-formation expenditures. And the proposal would apply to property transferred after date of enactment subject to a binding contract exception. Next one's near and dear to Eric's heart, 707 guaranteed payments. The proposal is to repeal the guaranteed payment rule and also remove section 736 and 760 and amend 761 to provide that a retiring partner remains a partner until complete liquidation. Both of those proposals effective 12/31/2021. 708 partnership terminations. Here, what the discussion draft wants to do is clarify that a partnership is not terminated if any part of the business is carried on by a person who was a partner in the prior partnership or by a person related to any of those partners. This change, I think, is designed to prevent related partners from structuring termination transactions, presumably to get out of elections. And that's sort of viewed as a clarification provision. 752 partnership liabilities. The discussion draft would add a new section 752E that provides that all debt, including recourse debt, are going to be allocable to partners in accordance with the partners' partnership profits, except for bona fide indebtedness from a partner to a partnership, but not for guarantees. There'd be a transition rule here acknowledging the fact that this is proposed to be effective 12/31/2021, that in essence, what that's going to do is result in a significant tax liability arising to partners who are currently relying on recourse debt allocations to preserve their negative capital accounts. So they're providing for what is, in essence, an 8-year installment payment to the government to pay your tax liability by virtue of the loss of the debt allocation. Mandatory basis adjustments are part of the discussion draft. So 734, 743 mandatory basis adjustments would apply, notwithstanding whether you've got built-in loss, built-in gain in assets. And then 751, definition of inventory, would remove the substantially appreciated requirement in 751B, treating all inventory as subject to 751. And then I guess finally, 163J, the business interest limitation rules. The discussion draft would amend 163J4 so that partners could not use the partnership's excess capacity to deduct interest expense from other sources. So right now, if you have excess taxable income flowing out of a partnership, the partner can use that at their level to deduct interest that's arising at the partner level. And they're proposing to really treat it as an entity and limit the ability to use that excess income to only arise within the entity itself, as opposed to allowing the partner to use it. So that's the widening proposals in a nutshell. I know I went through them quickly, but I want to give us a chance to have some spirited discussion here. Kara?
Thank you. What I really took away from that is that there is a tremendous number of changes that are on the table right now, and many have a December 31 effective date, which is coming up very, very fast. Well, we'll have a lot to talk about. Karen, before we get into the more technical aspects of the widen draft and other issues, I was hoping that you could put on your professor hat and talk to us for a moment about the why. So, what are some of Widen's goals in this, and why do you think that some feel that there is a very pressing need for partnership reform?
Okay, thank you, Kara. So the question really is, why are we looking at these reforms now? And each of us might have different reasons. But from my perspective, what I've seen in recent years is statutory changes and detailed regulations that are mostly aimed at combating specific partnership abuses that have come to light. And this development has greatly increased the complexity of Subchapter K without necessarily preventing taxpayers from inappropriately deferring or shifting gain. The flexibility, as Kara was saying at the outset, flexibility and complexity of partnership rules means that the government has a difficult time, or doesn't audit partnerships, and courts have a difficult time sometimes enforcing the rules. Partnerships, at least in some circles, have become widely viewed as a tax avoidance tool for the wealthiest taxpayers who can afford sophisticated advice. And for those of you who are sort of following developments from the tax court today, I know we'll talk a little bit about the Tribune Media case and sort of the benefits of planning. But can planning go too far? So these proposed reforms would emphasize curbing flexibility and improving administrability of the partnership rules. Limiting abuses is going to be hard to reconcile, I think, with the drafters' express goal of simplifying the partnership rules. Reducing taxpayer electivity is often going to mean complex mechanical rules, enforcing the remedial allocation method, mandatory basis adjustments, compulsory revaluations, and that will raise issues about whether small partnerships will need exceptions, so that what we might be moving toward is almost de facto a two-track system. Also, some of the proposals address long-standing vexing problems in partnership taxation that may have, do not have, any perfect solution. And we need to exercise caution for fear of what might be unintended consequences. And also, these proposals are interdependent, and they may work best or only if they're enacted as a whole. So ultimately, partnership reform, even if we agree that it is needed, and we may not agree on that, but even if we agree it's needed, the question is ultimately whether the benefit of these proposals outweigh their advantages. And I would like to borrow, Eric, from the title of one of your articles. You need to decide whether we are better off with the devil we know or think we know. Okay.
Thank you. So, Eric, let's assume that Karen is right. There is a need for some level of partnership reform. Is the Widen proposal the right proposal? And are there other options out there that might be better?
Well, I mean, those are two great questions. And I think really, ultimately, we're going to spend the next 40 minutes or so talking about all of that. Now, before I start, I'd just like to point out a couple of things. First is Monty Jackal, prolific author, has been writing a lot about this. And if you read his stuff, and I encourage you to, he's been saying a lot. Now, with Monty's stuff, I love Monty. We've worked together. I agree with about 20%, don't understand about 20%. And the other stuff I have to work through and decide, where I think it's going. But he is always worthwhile reading. Also, there is an article, it's either come out or about to come out, written by some folks at Baker McKenzie, Mayor Haddad, and some guy named Dick Lipton. I think I've heard of him. And it's a nice walk through these regs, and I want to thank them for sharing a draft with me. And finally, certainly Andrea and I, to some extent, are going to be beating up on the Wyden proposals. And we just want to say that I know that we both commend the staff for the work that they've put into it, because discussion has to begin somewhere. Someone has to be brave enough to put something out there, and they did it. And so hopefully they'll just be, and so far I think they have been receptive to comments from the taxpayer community. So maybe I'll just say a couple of things. I think there is some good, and this borrows from the Title of Tics article. There's some good, some bad, and some ugly about the Wyden proposals. So for example, 163J, the approach on 163J, trying to fix it. The approach to the limitation on interest deductibility that was put in 2017 was a fundamental and devastating conceptual error that was introduced into the code in 2017. And trying to fix something that was broken from the get-go, I think, is a waste of time. And they should simply acknowledge that it was a mistake and go back to partner level allocation. So that's one, just in my view, a complete waste of effort, going the wrong direction, adds unnecessary complexity. I think those of you who have spent time in the 163J regulations, I refer to it as the 11 steps from hell. You know what I'm talking about. So that's one example, just wrong direction. The right answer is out there, and the answer is scrap it and go to pure partner level. So some of the proposals, as Karen was saying, a lot of the proposals seek to limit the flexibility that has been part of partnership taxation since 1950, at least since 1954. It was really the Wild West before 1954. And the flexibility that's inherent in Subchapter K has been recognized as actually a good thing. It's even been recognized as a good thing and a legitimate thing by the Internal Revenue Service and the Treasury Department, right in the so-called partnership anti-abuse rules, right? You balance administrability and flexibility, and you come out with hopefully what is the right answer. I personally am deeply concerned that if all these proposals were to be enacted in the form, or substantially the form in which they've been proposed, that essentially partnerships would cease to be a useful form of business organization for all but the very most sophisticated, well-advised taxpayers, because the complexity that is Subchapter K is already pretty breathtaking. If mandatory revaluations were to come in, that is, let's pause and talk about that for a second. Mandatory revaluations, almost nobody really knows how that works when you have what are referred to as opposite sign revaluations. We all have our theories, but there is no meaningful guidance on how it works. One of my former colleagues, Jim Todd, who is now a partner at KPMG, and I worked out a theory of how we thought that it worked. And it was so complicated that we finally had to write it down because we couldn't retain it. And I remember when I was speaking about it with another one of my former colleagues, Philip Gall, who is at EY, he looked at me and he said, that's really interesting. That might even be right, but it can't be the law. And I said, well, why? And he said, because it's so complicated, you can barely remember what the theory is. So to do something like that and put it into the law without some more guidance, I just think that is a bad way to go. Now,
yeah, I mean, Eric, from my perspective, it just seemed like partnerships were very much under siege, to a certain extent in this discussion draft, because when you impose the remedial allocation method, it's almost as though it's a synthetic installment sale at ordinary income rates of the difference between basis and value to the contributing partner. And then to impose it on revaluations, now you've got all the historic partners who've got a synthetic installment sale at ordinary income rates of their property. And then couple that with the never terminating anti-mixing bowl regime, where historically under 731, we all grew up understanding you could take property out of partnerships, there'd be basis consequences. But just from an administrability perspective, back to Karen's point, I'm for simplicity, and I don't see this as simplifying and making pretty much, they're going to get you with ordinary income coming or going.
Right, but I completely agree. But let me shift to one that I think has some merit, perhaps. The consistent allocation methodology. This would require that among related parties, no special allocations. The idea is, I think, in many ways compelling, but the drafting is simply wrong. I mean, it is one. So let me give you an example. This is the way the draft works right now. If you have a partnership that is owned more than 50% by, say, members of an affiliated group of corporations. So if sub 1, sub 2 owned by a common parent, that those sub 1 and sub 2 own more than 50% of the partnership. If there is an unrelated third person in there, or say a profits interest holder in there, no special allocations can be made at all in that partnership. On the other hand, if sub 1 and sub 2 own less than 50%, you can make as many special allocations as you want, even between sub 1 and sub 2. It's just a conceptual error in the drafting. What I'm sure they meant, or what I strongly suspect they meant to do, was focus on special allocations between sub 1 and sub 2. And it's perfectly legitimate policy call to say, related parties, members of an affiliated group, we don't want you doing special allocations. I'm not saying it's right, but that's a perfectly legitimate policy call and completely consistent with other areas of the Internal Revenue Code, right? Where related parties themselves are subject to special rules. But as drafted, it's both over-inclusive and under-inclusive, just misses the mark of what they were trying to do. What do you think, Carrie, about that one? Good.
Yeah, that would also affect very few taxpayers, right? I mean, it really is a special rule for controlled partnerships.
Well, properly drafted, it would affect very few people. It's like Section 721C, which is the outbound rule.
Yeah.
Right. And when it first came in, right, when they were proposed, those regs were proposed, the trigger was 50%. And basically all of us said to the government, you know what, if you go up to 80%, you're going to get everybody you want to get, and the accidental participants will be very few. And they did. They were responsive. That's why I would hope that they would revise this if it comes in to do it right.
Right. That's a similar sense I had, Eric, with a lot of these, where if you applied in a related party context, a lot of these provisions are less offensive in a sense from a tax practitioner's perspective. It's applying it to a normal third party arm's length transaction that I think really sort of changes how Subchapter K functions.
That also fits in really with the 482 problems. Isn't this kind of all part of the same package? But for most of the partnerships that people are dealing with, these are really not going to be the provisions that impinge on them.
Right. I mean, one thing, if you really want to read some crazy complicated stuff, read the part of the Wyden proposals that tell you what happens if you violate the consistent allocation rule, rather than relying on a penalty regime, which there are a lot of penalty regimes in the Internal Revenue Code. They could simply tie into like a substantial valuation understatement, really bad penalties for doing that. People stay far away from that. Or tying into Section 42 for correlative adjustments. They have this really, I felt like I was reading Alice in Wonderland when I was reading what was going to happen if you violated this. They're deemed sales, they're gains, there are no deductions. I think it comes from truthfully, I think it comes from a deep congressional mistrust of Treasury. That's what I was getting, a real mistrust of trusting Treasury to do what Congress wants, and mistrusting or a lack of trust in the Section 42 regulations to really work properly, which might be right, but I certainly wouldn't come up with the regime that they came up with that nobody can understand.
It is awfully draconian, but probably intended to be awfully draconian.
100% agree. Still, it would be nice if it were understandable and rooted in something that we all could appreciate.
So is there a policy goal at any point to push taxpayers out of Subchapter K? I mean, is it, you said a distrust of Treasury, is there also a distrust of the partnerships and the practitioners? I mean, I kind of wonder that, given how complex it is, you can't expect that a lot of the smaller, even mid-sized partnerships are going to have the sophisticated tax advice to comply.
But I think that gets back to Karen's point about needing a carve out for small partnerships. And now we're in a two-tier system, which really raises a lot of the issues, even to Eric's point about the 50% partners who are subject to consistent percentage method. What happens in 1 year you are subject to it and the next year you're not. And the fact that we have no transition rules to deal with the fact that you've got partnerships that are relying on substantial economic effect right now. And, 12/31/2023, if this was to be enacted, the very next day, they're subject to a completely different allocation regime.
But it could be that Congress simply wishes all partnerships were S corporations. That is, I was mentioning earlier, that's a sense that I got, that if all these came in, partnerships would wither. And maybe that is the unstated objective. I don't think so. I really just think that the people working on this have been talking to people in the tax community, have been reading a lot of articles, and have been spotting things that maybe need attention. And, there's no way to get attention like putting something really draconian out there. But I would hope this does not make it into the bill, truthfully, that's coming through, because as interesting and maybe meritorious as some of these proposals are, they simply need time and work. I think I was about to interrupt you, Karen.
Well, a slightly different way of stating that, Eric, is I do think there is a significant mistrust about what sophisticated planning can do. And most of these, we have seen the abuses. You may think, well, okay, it's too broad a fix for an abuse. Why can't we handle the abuse under a specific anti-abuse rule, let's say? But those haven't really worked. So, I think that it is, I was on the ALI panel that looked at sort of a two-track system. I think if you want rules that deter abuse by sophisticated partnerships, they probably have to be tough rules, but you don't want to discourage other people from using partnership form. So you're almost de facto forced into that two-track system, I think.
Well, Karen,
Right.
I guess I want to challenge you on that. We have very robust anti-abuse rules in Subchapter K. We have 701, we've got 704C1B, 737, 707. I could go on.
We have yes, we
So,
do
yeah,
have.
I feel like we have a process, and frankly, the 704B regs, while many may lament when they're on example 43B4 little I, but they are very well thought out. It is a regime that, to me, it makes sense. You've got foundational principles with minimum gain, chargebacks, and we'll talk about debt allocations in a moment, to make sure that the right partner is taxed on their gain at the right time. And for someone who has spent her career in the real estate industry, I can tell you that trying to get rid of partnerships and pushing everyone into an S corp arena is going to do significant damage to the real estate industry. That is a huge driver in the economy. And I think, that's something that ought not to be done in haste to create a whole new regime and system that will discourage investment in a particular significant part of the economy.
That may be saying we should, this notion of scratching the substantial economic effect rules and moving to PIP. I kind of doubt that that's really going to go through. And PIP is really just another facet of substantial economic effect. That's one that I have some trouble accepting. And you think about how partnership agreements are done now with target allocations. It really is PIP anyhow. But I still think there are anti-abuse rules that have not necessarily fared well. And I think we might, wearing different hats, we might be able to agree on that.
Right. I agree with Karen. I think it was Howard Abrams, or I first heard Howard Abrams,
yes,
professor at Harvard, who say that anti-abuse rules are an admission of defeat by the government, an inability to draft the rule you really want to draft. And so I think anti-abuse rules have their purpose, but that's why I think the consistent allocation methodology, has merit among related parties, probably affiliated groups. I would be nervous about extending it further. I worry desperately about attribution rules because I know I don't understand them. So they just spook me. So I'm worried about that. But, you know, you were mentioning, Andrea, real estate. I mean, I don't know who said, somebody once described real estate as the third rail of American tax policy. And I can't remember who said that, but I think it's true. And I do think people on the Hill should look at what has happened to the American economy when they've done something that inhibits investment in real estate. They just need to think long and hard about that. But that takes us actually really nicely to the rules, the proposals dealing with Section 752 and allocation of partnership liabilities. And I think we should note, for people who haven't seen it, the Tribune case came down today. That is a leveraged partnership transaction designed in part by Andrea Whiteway, you know, who is on my bottom left screen. And so congratulations, at least in part, because it was partial win, partial loss. I think that the interesting thing about the case is that the judge read the regs and saw that leveraged partnerships work, saw a clear regulatory path to what the Trib did, and declared victory on that. And then there was another piece where the judge, really in very traditional legal analysis, right or wrong, very traditional legal analysis, said, yeah, that other debt doesn't really look like debt. And without getting into the merits of that, but I think that case actually, for some people, they're going to hold up that case and say, this is why the Wyden proposal for Section 752 needs to be enacted. And so the proposal, there are two proposals dealing with Section 752 in Wyden. One would change the economic risk of loss rules under Section 752 to make it so that credit support, guarantees, indemnities, stop loss agreements, what have you, do not cause otherwise non-recourse debt to become recourse, do not change the party who bears the economic risk of loss for debt. That, you know, I wrote a long article a long time ago about how ridiculous the economic risk of loss rules are, and I continue to think they're ridiculous. So it's hard for me to do anything other than say, that's an interesting approach that Wyden takes. That, personally, as I was one of the drafters of the New York State Bar Report on some of these rules, and as we said in that report, I would probably narrow that and have it apply only to disguised sale transactions. I just think it's a little broad, truthfully. But I'm not, I don't know about you, Andrea or Karen.
Yeah, I mean, I think if you, oh, go ahead, Karen.
Well, no, I was just saying, I have the same feeling in reading that. Is this really, again, it's, apologies to Tribune, this is a disguised sale problem. And it may be a great fix for a disguised sale problem. But trying to figure out what are the partner shares of profits, that's going to change over time. That the current rules are intended to sort of really to make sure that you have enough basis to take deductions. So if 704 is working right, query whether it is, but the thought was we didn't really have to care too much about the allocation of liabilities. And that was fine as long as you were looking only at 704, but liabilities are also important for debt finance distributions. So we kind of missed that part of the picture. And I at least would be perfectly happy seeing this narrowing to look at disguised sales.
Yep.
Right, and I certainly think that's a point that we've made before. I think everyone has in articles and at conferences that to the extent that the government doesn't like the result you get with a debt finance distribution allocation of recourse debt, there certainly can revise that rule in the regulation or frankly statutorily as they're proposing to do with the reimbursement for pre-formation expenditures. But to sort of make a wholesale change to how debt is allocated for partnership tax purposes, changing 752 and the follow-on consequences in 704B just seems to be a little too far.
Right, and I think that one nice thing, if they were to narrow, and by the way, I should say that the article I wrote 752, it was written, more than half of it was written by Jenny Alexander at Deloitte.
We expected that, Eric.
Yeah, and most of the thinking, right? Anyone who knows me knows most of the thinking was done by Jenny. But one nice thing about narrowing narrowing the proposal and having it just apply for purposes of 707A2B is all the transition rule issues would fall away, right? A lot of the problems with coming up with new rules is figuring out how you're going to get from here to there. And if they just change, if they just narrow it, they'll hit pretty much everything they want. Transition rule problems fall away, move on. But yeah. Should we talk about non-recourse? Because Karen, you talked about the non-recourse rules, right? Because there are two proposals. One is to change the recourse.
Yes. And part of it says in accordance with profits, but maybe this is where you're going, Eric. For the non-recourse rules, we have 3 tiers of profits. We might end up with something that isn't all that different from the true importing the non-recourse rules in, rather than a straight profit allocation.
Right. So what we're talking about now is whether when you're allocating non-recourse debt, you no longer have 704B minimum gain, 704C partner minimum gain, but rather we just go to what we use now under the regulations as a 3rd tier allocation of partnership profits, and query whether if you had PIP, you don't get any debt allocations for recourse debt. I guess partner debt is still treated as partner debt, so you would have partner non-recourse deductions. Seems like they'd need to keep the tiered regime going. And you're going to attract a lot of debt in that 2nd tier because everyone has to use remedials.
Right, or they'll have deductions, right? Or they'll have deductions going one way and the basis going another. And that is one of the guiding principles, right, of partnership taxation is the interposition of a partnership between owners and activities. It's not really supposed to change the tax answer, right? Partnership is fundamentally an information collection and reporting vehicle. And with some of these changes that they're making, the interposition of a partnership between owners and activities will actually change the tax answer. And I think before they do that, so I'm not opposed to change just because it's the way we've always had it, but there's a reason the way that it is the way it is. And I think we should think long and hard about whether the people, what's his name, Mark Johnson, who helped design Subchapter K, he knew long before any of us how all these things tied together. And I worry about delinking them.
Yeah, and I mean, we've made the point before, the 1982 ALI study that I think Karen was referencing that talked about, it was a very well thought out multi-volume analysis of Subchapter K, really said that the intent is to provide for a flexible regime. We don't really, the reason we have the debt allocation regime we have, as I understood it from colleagues of mine have talked about it, is the government was worried we need to give you some guidance because otherwise you won't know how to allocate this debt. But frankly, flexibility is, there's no need to prevent flexibility because of the way 704B is structured, so that you will ultimately have the gain being paid and allocated to the right partner. So allocate the debt however you want to in the meantime was really the sense I got from the ALI report or ALI study from 1982.
We got an audience question that's somewhat related, which is, does the widened debt allocation place any significant weight on economic risk of loss?
Well,
0.
Yes. So, I mean, except for, so maybe backing up and for others. So right now, the world of debt allocation is broken into 2 parts, recourse debt and non-recourse debt. But to determine whether debt is recourse, you use this sort of strange test in the 752 regs that looks to economic risk of loss, which most of us refer to as an atom bomb test, right? So an atom bomb goes off, all partnership assets worthless, including cash. You figure out who would have to pay on partnership liabilities. That's economic risk of loss. It is an entirely bizarre construct that came into the Treasury regulations very intentionally, off-code amendment to overrule Rafin. It's been there a long time. This proposal would partially undo, and I say only partially undo because of what Andrea just said, partner debt. So if a partner lends money or someone related to a partner is actually the lender, then the partner would be allocated the debt. But credit support, guarantees and the like was done in the Trib case, would not attract economic risk of loss.
General partner in a limited partnership. for instance. No recourse debt allocation. It would all be non-recourse now.
Right. Exactly. Should we talk about PIP? Because there's so much to talk about. Do you want to talk about PIP? Folks, or?
I want to
Okay,
learn about PIP, so I need you guys to talk about PIP.
Oh, goodness. So there's this big part, Andrea talked about this, that would scrap substantial economic effect, which is those tortured regulations under 704-1, and would replace it with PIP and instructs Treasury to issue guidance under PIP. And
which we don't have right now. There are no regs, right, Eric, on PIP?
Yeah, we have a little bit of guidance, but in fairness, it is a facts and circumstances test. And there are some people who believe that that there's one answer under PIP, which I personally think is ridiculous. Whenever you have a facts and circumstances test and you have different lawyers looking at the same facts and circumstances, that means different people can reach reasonable judgments about things. So I reject out of hand the notion that there's only one answer under PIP. That may make the government nervous. And I think that from my discussions with people, really fundamentally what Congress wants is they want the 5-year rule or presumption in the 704-1 regulations that make timing-based allocations work. They want that gone because I feel like that's really easy to abuse. They want the value equals basis rule or presumption gone because it's counterfactual, non-economic, and they believe subject to abuse. And because most partnerships, as Karen said, rely on targeted allocations or some other distribution-driven allocation methodology, they want the IRS and Treasury to come out with more guidance about what PIP is. But yeah, the expression, throw the baby out with the bathwater? I mean, wow. This is a startling proposal, and I think instead they should just do what they want to do, which is tell Treasury to change the regs, do something off code, and tell Treasury to kill parts of the regs that Congress doesn't like.
And actually, Eric, if we move back and say we keep the substantial economic effect test, which is probably what we're going to need to keep, and it's really a directive then, regulations under PIP. I mean, I think that all can be done. It's not that the idea is bad per se. It may just be that there's a slightly different way of getting to the result that the government wants. And also the C test is used. So for the fractions rule and so forth, it'd be very hard just to get rid of it. Can I put in a pitch for basis adjustments?
Absolutely.
Because I'm wondering now, okay, so we've got under section 743 and 734, there are basis adjustments that are almost entirely optional. We had some changes in 2004 to prevent duplication of losses. Again, anti-abuse, targeted anti-abuse measures. And those basis adjustments for 743, for example, a sale of a partnership interest or transfer of death, those rules allow the purchaser or successor to obtain essentially a personal basis adjustment inside the partnership to wipe out what otherwise would be gained that would be taxed to her. And taxpayers make those elections if they're trying to wipe out gain. The 743 adjustments, I think, work pretty well. They're very coordinated with 704C, so that really all that this proposal will do is make them mandatory. Now, we may or may not think that that's the right way to go. But the 734 adjustments occur when I have a distribution and the distributee recognizes gain or loss or takes a basis in the partnership property that's different from the partnership's basis. Those 734 adjustments, again, optional except for the one mandatory part, those basis adjustments really don't work very well because they are adjustments to the common basis of partnership property. It's a pure 1954 construct, and it may actually, doesn't take into account probably 704C at all. So for decades now, at least, people have been trying to figure out how could you make the 734 adjustments work. And one approach this is the Andrews article that's cited in the Wyden text, would really go back to almost a 54 model with sort of a partial liquidation of the distributee's interest when the distributee continues to have some remaining interest. What the actual Wyden proposals do, though, is to take what I think of as the 704C approach. And that is to try to make the partner's shares of pre-distribution and post-distribution gain, taking into account what may be consequences gain recognized by the distributee on when she receives the distribution, trying to take that into account and overall make individual partner-specific adjustments to preserve each partner's share of pre-distribution gain. So basically, and that does, if you think about the interdependentness of these provisions, that requires a mandatory revaluation at the time of the distribution. And then I assume mandatory remedials, because now the gain that's been booked up has to be allocated in accordance with the manner in which it was booked up. And we keep the allocation rules under 755 for allocating basis adjustments among the partnership assets. This is, again, not a new proposal. This is almost verbatim from the Camp proposals 2014, very minor changes. And if anybody's kind of wondering how do these things work with that unclear description that I've given you, there are 5 examples in the Camp, in the technical explanation of the Camp proposals that are very helpful. But the net result, and then we can sort of think about, should we do this, but kind of be aware what the net result is that even on a current distribution, you could receive, even if you receive just a cash distribution, if that triggered gain, then you could have these mandatory adjustments. Or if the partner receives property that isn't exactly, doesn't carry out exactly her share of appreciation in that property, then you could have these mandatory adjustments triggered. So, and you could also have 751, which would no longer have the substantial appreciation test, also triggered. So I'm not a fan of trying to perfect the partial liquidation method, but I know that most people think that it may not work. But if I'm right in thinking that this is that each partner would wind up with a different basis in the partnership property, how workable is this? What is your take on that?
Well, if I could start by just disagreeing in part with
Okay.
part of your introduction, I think that you're right that the people who put 734B into the code and drafted 755 didn't really conceive of it as working with 704C, in part because 704C was optional. I think it's very clear that section 755 as drafted today tells us the asset to which a 734B adjustment attaches, no question. But I think that when different partners have different shares of forward and reverse 704C amounts in an asset, I do think that maybe 755, it's fair, doesn't speak to that, but I think 704-3 very much has a role to play in telling you whose share of built-in gain is reduced. And I think when you work through the math, the person who recognizes the gain should have their share, this may be intuitive, of inside gain reduced. It's not the rule, but I think that's a reasonable approach under 704-3.
And I agree. I think you can, I've sort of argued you can get there, but there isn't any clear authority to do it.
I agree. I agree. I think the path that you laid out, I mean, let's face it, Karen, you've done more thinking about this. You and Howard have written more scholarly articles, Howard Abrams, written more scholarly articles about how 734B is broken. And the network of interconnected rules that would have to be made to work properly to make mandatory adjustments work. As you said, mandatory revals, we already talked about how that is an impossibility in the next few years. To make it all, I just don't think it can happen. So as much as for me personally, maintaining inside-outside basis parity is a North Star in the way I interpret these rules, it's just, I think it's just too much. I think the whole the whole complex that is Subchapter K will collapse.
Let me throw out something that I know you'll disagree with. Or at least I'll be very surprised if you don't. Is a lot of this problem is kind of the wide open non-recognition rules. And those are kind of 54 model as well. What if we, now we have, say you had mandatory revaluations and you could get them to work. What if you expanded 704 C1B to reverse gain? What if you, is maybe part, and I'm not saying that I would say that's, you know, necessarily the right way to do it, but I think that maybe part of the solution should be more gain recognition when property goes out of a partnership.
Now that is spoken like a true academic, and I'm going to let Andrea address that one.
Yes.
Well, I mean, I know that's in the discussion draft, the proposal that they at least will consider whether the anti-mixing bowl rules ought to be extended to revaluation gain. I'm not even sure I know how to respond. But, you know, getting back to basis adjustments, obviously with the Jobs Act and yet again, the anti-abuse rule to deal with the loss duplication transactions, in the positive basis adjustment arena, that's, you know, making the basis adjustment is a helpful thing to the taxpayer. And if they're electing not to do it affirmatively, they're doing that, frankly, because it's too complicated. The taxpayers who are foregoing the 754 election basis adjustment regime are doing so because it's too complicated. And now we have this proposal that says we're going to not only have it happen here, but we're going to have it happen down the tiers. And, you know, requiring the partnership to value property. I was struck today, I don't know if anyone else has poured over the 100+ page billionaires tax proposal, but in that tax proposal, you know, they're even acknowledging that non-tradable assets are not going to be subject to these rules until they become tradable, or, you know, so they're acknowledging that non-tradable assets is not the appropriate time to tax them, yet this regime is doing just that with the imposition of the remedial allocations. What we're talking about now, where you're suggesting that perhaps we apply, you know, anti-mixing bowl rule gain to revaluations so that any property that ever comes out of a partnership is going to be taxed to somebody, even though property is not the same as cash. It's a non-tradable asset, and there seem to be acknowledging that in the billionaires tax proposals today. So I'm at a loss.
Well, I was just going to say, when all this was put into place in 1954, we were much more tolerant of non-recognition, deferral, shifting. We didn't think it was a big deal. We now have a regime where outside Subchapter K, you really can't do like-kind exchanges except for real estate. So when property goes out of a partnership, I'm really swapping my piece of property for another piece of property. I mean, I think that maybe this non-recognition regime just looks like it's very different from the rest of the tax law.
So
well, could I 351 transactions with a corporation? You can contribute property into a corporation tax-free, but now we're saying you can't do the same thing into a partnership.
And picking up on Subchapter C, and I have one other point I want to make in the last minute and a half. With Subchapter C, you can do spinoffs, right? There's 5-year wait. Under 355D, you have to wait, but then you can break up a corporation. And so all of a sudden, partnerships are going to be significantly worse on the way in and impossible, you know, right? It's like the Roach Motel. You'll never get out. And that to make partnerships worse in every way than corporations strikes me as kind of bizarre. I did just want to touch on two quick things. I'll just take 15 seconds. 707C repeal and 736 repeal. I actually don't care about whether they're repealed or not. I think most of us could live fine without them. But people who think they can just be repealed without some guidance about what you do in situations where 707C would otherwise have applied, or in redemption retirement of partners, that's a big mistake. Someone's going to have to come up with rules telling us what happens in those situations. There, I got it off my chest. Thank you.
It also will have to figure out about partners as employees if it's all governed by 707A.
Exactly.
There are so many issues. You know, I have to thank you guys. This is tremendous. I had no idea that all I had to do is ask the three of you if you want to talk about partnership tax issues and then let you go. And you organically hit all of the topics that we had initially discussed, and it was perfect. Well, and I can't thank you enough. This is a lot of fun for me. I learned a lot. I took a bunch of notes. I hope that everyone else did too. And we'll definitely have to do another because we didn't even get to hit the House proposal or the you know, the giant elephant in the room of the question of whether any of this is really going to pass and what can we expect. So we look forward to having another panel at some time and having you all back. But I want to thank you. I want to thank everyone that watched today and sent in questions. We appreciate it as always, and we look forward to the next time. Have a great rest of your day, everyone.
Thank you.